can legitimately arise, among others due to the country's specific macroeconomics landscape. That has happened in the past. So the Governing Council will make the assessment of whether a country meets the eligibility criteria or not at the time when it has to make those determinations. And it will do so having a sort of threefold assessment, if you will. First of all, it will determine a comprehensive assessment of market and transmission indicators. There's a whole range of such indicators. Second, it will at that time evaluate the eligibility criteria. And third, and that's very important, it will have to make a judgment call that activation of purchases under the TPI is proportionate to the achievement of the ECB primary objective. Now, those of you who are familiar with the legal requirements and with the concept of proportionality will have understood what I mean by that, but this is obviously operational in relation to any activation decision that is being made.
Thank you, President. And now the next question goes to Pablo Rodriguez of El Mundo. Pablo, please.
Yes, thank you very much, Madam. I have a couple of questions, if I may. The first one is that 14 years ago, one of your predecessors here, when there was a rise in the rates, he dismisses the argument
14 years ago?
Sorry? 14.
Oh, okay.
14 years ago.
14?
14.
Okay.
He said he dismisses the argument that the rise will put further strain in the peripheral countries. And he said, I don't buy that argument. I was wondering if now you kind of buy that argument, because in a sense, this new instrument you are announcing, even though it's just an extra one, basically those criteria describe pretty well those countries in problems that 14 years ago may need the help of the ECB. So do you think that the economies are more resilient right now, or just an instrument as it is, it will help them to compensate the effects of the new rate? And the second one, if I may, is the Spanish government has announced a new tax on banks for windfall profits. I was wondering, because they explain they do that because of the interest rates rise. And I was wondering if you have an assessment, you will eventually have an assessment, and you have an opinion as you have in the past, because it has happened before in other countries, and I was wondering, you think it's actually a good answer for after what has been announced, or just because of what has been announced today here? Thank you.
Thank you so much for your question. I think your second question will be addressed by my colleague, the Vice President de Guindos.
Well, good afternoon, everyone. Well, it's very difficult to give an opinion when you do not know, the concrete details of the tax. We do not know the characteristics. We do not know whether it will be a tax on profits. It will be a tax on assets. So it's, that's the first thing that we have to say. We do not know the details, and so our opinion cannot be complete in that respect. What I can tell you is what has been our policy line in the past with respect to taxation of banks. No? And if you look at our opinions in the past, they are quite clear. What they try to make quite explicit is that the tax should not impair credit extension, credit growth, because this is important for economic activity. Second, that we should try to avoid any sort of tightening of financing conditions for households and corporates. And finally, that the tax should not damage the solvency of the banking industry. This has been always, in the opinions that we have produced in the past, it has been always, this kind of message to the governments. But I repeat again, we do not know the concrete characteristics and features of the Spanish tax that has been announced, as you have said, by the Spanish government, and so in order to have a much more concrete and specific answer and response and opinion, we will have to wait a little bit.
Yeah, and to your first point, that helps me to yet again come back to TPI, because in a monetary union, there is an inherent risk, particularly the monetary union that we have here in the euro area. There's an inherent risk that a large shock can create fragmentation risks. And that can lead to self-fulfilling market dynamics that are not warranted. And it matters for the singleness of our monetary policy in our monetary union. But those impediments can have different sources. And that is the reason why we have several tools. As I said earlier on, we have the flexible reinvestment of PEP, which has been deployed, is currently operational. We have OMT, which was decided back then for another unwarranted disorderly market dynamics, but having to do with more country-specific matters, and closely associated with the redenomination risk, because that's really what it was designed for at the time, if you remember. So we were short of this particular tool, which is the one that we have in front of us, the transmission protection instrument, that is not related to redenomination risks, but to the unwarranted disorderly market dynamics that can impair the proper transmission of monetary policy throughout the euro area, which is, as I said again, it's with no limitation ex ante, which has been designed carefully with adequate attention paid to the safeguards that are necessary for that instrument to be valid, and with a creditor seniority that is pari passu with any other creditor in order for it to be efficient and not to crowd out. So that's what we have done. And I can assure you that we would rather not use TPI. The Governing Council would rather not use it. But if we have to use it, we will not hesitate. We will not hesitate. Thank you.
Thank you. Next question goes to Roland Koopman of the Dutch television channel RTL. Roland,
Thank you,
please.
and good afternoon, Madam President. I'm over here.
Where are you?
I'm here, to your right.
Oh, yeah.
All right. Okay, I've got two brief questions. Your previous forward guidance to this rate decision is about 5 weeks old. Yet the rate hike decision is a lot bigger than anticipated. Did the monetary conditions in the Eurozone deteriorate that fast, or is the agreement on TPI giving you the ability to go further than you anticipated? Second question, you stated that you're on the path towards normalization. What interest levels are considered normal by the ECB? Thank you.
Thank you very much. The reason we decided by total consensus around the table to depart from the signal that we had given back in Amsterdam was twofold. Number one, we had clear realization of upside risk to inflation, and I can give you a list of those examples. Inflation going from 8.1% in May to 8.6% in June, way above our forecast. Seasonally adjusted month-on-month inflation rates that show strong inflation momentum for nearly all components. Number three, a broad range of indicators of underlying inflation that have continued to increase, and pipeline pressures that are rising to record high levels. And added to that, which relates essentially to inflation, the euro-dollar rate that has fallen substantially in the last few weeks, which obviously has a bearing on inflation going forward. So it's on the basis of that set of monetary policy stance-related elements that we have taken the decision. As I said, twofold, inflation-related, and second, the fact that the concern that we had about monetary policy transmission is addressed by, number one, the deployment of the TPI, the PEP flexible reinvestment policy, and second, the unanimous support of the entire Governing Council to a strong and powerful transmission protection instrument that I have just described earlier on. So on the stance front, we had good reasons to revisit, and on the transmission, we are confident that the existence of that mechanism, its ability to be deployed, is actually reinforcing our capacity to deliver on our price stability mandate and to walk that journey of monetary policy normalization. Now, as I said earlier on, going from the signal 25 to the 50 that you are seeing now is a higher step out of negative interest rates. So we're now moving in one go to zero. Does that mean that we are changing the terminal rate at which we want to arrive? No. Does that mean that we are going to move extremely fast? As I said, we will be operating month by month, meeting by meeting, on the basis of data, and we will adjust and calibrate accordingly. We are much more flexible in that we are not offering forward guidance of any kind. I was asked several times the questions about September. There is no such thing. We are data dependent. But the ultimate destination of our policy path remains the same, which is to progressively raise interest rates to broadly neutral setting. That's where we want to arrive at. Okay? And if you're asking me next, what is the neutral setting? At this point in time, I don't know. What I can observe is that it has changed over the course of the last few years for a reason of factors having to do with demographics, with productivity and all the rest of it. And as seen by markets, it has also significantly adjusted in the last few weeks. So we will cross that bridge when we cross that bridge. Thank you.
Thank you. And the next question goes to Christian Siedenbiedel of FAZ, Frankfurter Allgemeine Zeitung.
Yeah, Madame Lagarde, do you think this is a historic moment? Are you personally glad that the time with the negative interest rates is over now?
I tell you something, I think it's a rather historical moment, for me at least, for two reasons. One is, it's very good when a whole team, the whole governing council, 25 members around the table, actually are in complete alignment and support for a transmission protection instrument which we regard as critical in order to properly transmit our monetary policy going forward. So in that respect, at least from the President of the ECB point of view, yes, I think it's quite a gratifying moment. It means that staff has done an enormous amount of work, that all members of the committees that are bringing together the expert of the national central banks, Bundesbank included, of course, have worked really hard, and that we have come to the same view without any reservation. So it is important in that respect. I think, it's the first time in over a decade that we raise interest rates. And moving out of negative interest rates, by all accounts, certainly to me, is going to facilitate a number of things that we can explain to European citizens in order to help them understand what we are trying to do in order to reduce inflation and in order to procure price stability. So in those two respects, yes, but I have a short history as a central banker.
The last question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you. Good afternoon, and thank you very much for the opportunity. If I may go back to TPI, you called it a program and a mechanism. The market calls it a shield, and we look at it as a shield that can protect all countries, but it's also complex, and by the way you described it, how fast can you trigger if a country needs this kind of shield? And once you trigger it, it means that the country is protected for as much as needed. And then a second question on TLTROs, because banks are worried that you might modify TLTROs that targeted longer-term financing operations with the rise of interest rates, whether it is so, whether it was discussed or it is on program. Thank you.
Thank you very much. The transmission protection instrument is an instrument. Okay, it's one that is intended for transmission of monetary policy throughout the euro area. So we intend to use it as a tool to make sure that monetary policy is transmitted throughout the region, our region, and is smoothly transmitted without being impaired by unwarranted disorderly market dynamics. It is not so complicated. You will see, because the press release will be out in 2 minutes, and it will not give you, by the way, all details. Okay? It will give you some of the eligibility conditions, some key terms and conditions, but you should not expect all details to be there, because there is an element of discretion and judgment on the part of the Governing Council members to decide or not activation and to assess eligibility or not. And there are certain components that are best kept unpublished, undisclosed, and commented upon. And I'm sure that you understand. This instrument has been developed in record time by our teams. They can work fast, we work fast, and we can do so at any point in time in relation to eligibility, in relation to activation, in relation to drafting, which has been the case. On TLTRO, as you will have noted in the monetary policy statement, there is a particular sentence which says, in the context of our policy normalization, we will evaluate options for remunerating excess liquidity holdings. You know, what has worked in one direction has to be identified, analyzed, and properly addressed in the other direction. We are now in the process of normalizing. Other principles apply, and that's what we will do in the near future. Thank you so much.
Thank you very much. That brings our press conference to an end.
As predicted, that news conference wraps up just seconds before that press release comes out, before anyone can actually ask any questions about it. I think if we all hear TPI just one more time, our heads might explode. From New York City this morning, good morning, good morning. This is The Open. I'm Jonathan Ferro, and here's your price action. This euro move fades pretty quickly. It's a 50 basis point rate hike. It's the first rate hike since 2011. We're back to zero on rates of the ECB for the first time since 2014. And look at this rollover in the single currency. Euro dollar basically unchanged now at 101.71. Look at peripheral spreads as well. In Germany, the 10-year is basically unchanged at the moment. You have a look at Italy, we're up by more than 20 basis points. The 10-year up by 25. The 2-year up by 30. And I have to tell you, looking at spreads right now on German 10s versus Italian 10s, 237. The wide to the year, 242. We're not far off from the wide to the year just a month or so ago. The equity market here stateside about 15 minutes into the session, shaping up like this. We're down about 1/3 of 1% on the S&P. On the Nasdaq 100, we're down 1/10 of 1%. Take a listen to the ECB President, Christine Lagarde.
The combined forward guidance that existed for September is no longer applicable. From now on, we will make our monetary policy decisions on a data-dependent basis. We'll operate month by month and step by step.
We'll see you in September. Mike McKee's going to break down TPI for you in just a moment. I want to cross over to Danny Berger out of Frankfurt for more. Hey, Danny.
Hey, John, it's clear that the ECB has been changed by this decision. That language from Christine Lagarde there, I think it bears repeating that this decision and forward ones will be data dependent, will operate month by month and step by step. Forward guidance, the door is closed to that. Even the September rate hike, where before they would say it would be bigger than 25, she says that's no longer applicable. I have to say, John, it is pretty remarkable that this was a clear unanimous decision, not just on TPI, but this rate hike as well. It was clear that she tied the two together. And look, Christine Lagarde over and over again in that press conference when it comes to TPI got question after question about Italy. She batted every single one of them away. To one point, not even willing to say Italy, saying the country to which you referred to. She says they don't make political analysis. That's not their job. They're looking for unwarranted moves. We're getting details just now on the TPI that they're laying out, but she laid out 4 clear criteria for it. Again, she didn't speak exactly to whether Italy meets that criteria or not, but really emphasized, John, all of this in terms of who gets access to the tool is down to the discretion of the Governing Council.
Danny Berger from Frankfurt. Danny, thanks for the coverage today. I appreciate it. Mike McKee gets the job of going through that press release. Let's get over to Mike now. Hey, Mike.
Hey, John, unfortunately for you, we don't get the answer to the question you were asking. How big is it? They say it is going to be based on the need, rather than the need of any particular country, rather than setting out an amount at this point. It will be used for the purchase of secondary market securities issued by government agencies in the Eurozone. Jurisdictions experiencing a deterioration in conditions not warranted by country-specific fundamentals, countering risks to the transmission mechanism. The scale depends on the severity of risks facing monetary policy transmission, and you've already heard that these are not going to be ex ante. It already has to have happened. The other four criteria that Danny was talking about is any country receiving this kind of aid would have to be in compliance with the EU fiscal framework, not deeply in debt, absence of severe macroeconomic imbalances. In other words, it has to be not their fault. Fiscal sustainability, they've got to be able to pay this back. Their fiscal path has to be sustainable. And then they have to have sound economic policies in line with the country's commitment to the recovery fund plans. The key here is, according to Christine Lagarde, that this was all decided unanimously. The governing council would rather not use it, she said, but if we have to use it, we will not hesitate. So they don't tell you how much it's going to be, which might be a deterrent to the markets for pushing spreads too wide, but they do tell you they will have to use it. She's trying to say, we got the bazooka, we're not going to tell you how big it is, but we are not afraid to use it.
Mike, this might be a stretch, but this headline here, private sector securities could be considered. Big problem for the Eurozone over the last 10 years has been the link between the sovereign and the financial sector. If we are really concerned about the transmission of monetary policy, and this is a mechanism to make sure that's not impaired, would it be a stretch to say that they might consider buying, say, the debt of banks in the Eurozone in that particular country?
Well, the way you read it, it doesn't suggest that it would be impossible. The question is, do they really want to do that? And they do phrase it as if it's needed. And that's going to be the question. Do we see transmission problems? And this is supposed to be the transmission system, not the underlying balance sheets, that would affect those banks or other private securities issuers. So we'll have to wait and see on that. They're not giving us enough information. It is interesting that they end this press release by talking about the PEP reinvestment flexibility that they have, and they mention the OMT, the outright monetary transactions system that they set up during the Euro crisis and have never used. So they're kind of letting people know we have all these tools, we have this new one we added to our toolbox, and we will use it if necessary. I guess it would depend on the nature of the crisis, which one they would go to first.
Interesting. Mike McKee, thank you, buddy, as always. Mike McKee got the honour, the privilege of going through the TPI press release. Flowbank's SD Dweck joined us now, Eric Nelson and Wells Fargo as well. SD, you've heard all of that. I hope you're still awake. Not because of Mike, but because of that news conference. I've got no idea what half of this means anymore. SD, do you think that Italy is eligible for what's been outlined today?
I think Italy is one of the countries that they need to keep contained and to keep it within the euro. So I think they would find a way to make it eligible. From what we heard repeatedly is that there aren't so many underlying details. This is more, I think, a way of saying, don't test us, don't push the boundaries on Italy because we will react. And if it isn't the TPI, it's one of the other acronyms that they still have available. And between all of those, they will continue to contain spreads and ensure this transmission mechanism.
Eric, you've had your doubts about the sustainability of a rally in the euro. Those doubts are mainly because not of what happens today, but ultimately you think any particular rate hiking cycle from this ECB is not going to be long. Have your thoughts on that changed?
Not particularly, John. I understand the forward guidance is different now, and they've opened the door to larger hikes or potentially more 50 basis point hikes. But the fundamentals, in my opinion, have only gotten worse since June. And to me, if we zoom out a little bit, the energy crisis is still a problem. Italian politics have gotten worse. And the fact is, the ECB cannot increase the flow of gas to Europe. They cannot change the political situation in Italy. they can certainly limit euro downside, but to me the fundamentals still point to euro downside, even if the ECB has some sway in limiting that.
Eric, the potential gas shutoff raises a really important question, and I had someone reach out to me just as that news conference was ongoing with that particular question. I think this one's important. Did we get a decent idea of the ECB's reaction function, just as far as this question is concerned, how they would respond to a negative supply shock? Have you got a decent read on that? Because if we are truly in a world where forward guidance is dead, we need to really re-establish how they're going to react to certain information, and that's an important data point for many of us. Do you understand how this ECB would respond to a negative supply shock?
Well, right now, John, they're staring at 9-10% inflation and a rate that has only just gotten back to zero. So in the absence of a very clear and already in motion recession, they're probably going to push toward more hawkishness. My question is, we fast forward 3 to 6 months, and maybe the Eurozone is in recession, and there is a real energy crisis that's actually manifesting in real time. At what point does the ECB say, this is too much, we can no longer hike rates and worsen financial conditions in the face of this economic situation? And that is what worries me about the euro outlook into the end of the year.
Esther, if you had to make a call right now for the September meeting, what would it be?
I think that the reason they don't want to make that decision is exactly about this natural gas and this energy crisis. I think this is what's weighing on them. If suddenly the flows get shut off, it's basically automatic guaranteed recession and very big dips in GDP, especially for Germany. So where you'd have one of the more hawkish countries, there's also this big question about growth and how you deal with it. Coming off of today, if the gas flows continue and inflation doesn't come down much further, so again, if the gas flows continue, they could do another 50 basis points, but if you have any kind of concern that those might stop or have been lowered even further, then I think they would want to get those 50 basis points. They wanted to get back to zero, and then maybe they have to go a little bit slower going forward, because that fourth quarter and that first quarter of next year are starting to look really, really tricky.
Euro turning around a bit, euro dollar 102. Esther, I just wonder off the back of all of this, what's the trade? I'm seeing a headline like this, private sector securities could be considered for TPI. I just wonder how many people start to take a second look at that in the coming days and wonder what that means. Esther, what is the trade off the back of this?
Well, at the moment, the euro is having the most reaction, right? The equity market hasn't been as excited about the 50 basis point hikes. And you saw this move, even the euro is somewhat undecided. It's better in the sense that it reduces those interest rate differentials with the dollar, and everyone would be happy to have a slightly softer dollar at some point. But it doesn't feel like there's so much confidence that this is going to be an aggressive rate hike cycle. And as you said, the TPI is giving a lot of different options to have that sort of dovish tilt and protect the Eurozone. And if you sort of net that out, I'm not sure how positive it is for the euro, or I'd say over the medium term.
Eric, I wanted to give you the final word. Your call on parity, a break of that within a month that you made about a month ago, turned out to be perfect. Just a final word in 20 seconds. Your next call on the euro, what is it now?
John, the most important thing here is positioning is still not stretched in euro downside. We think the risk reward still favors euro lower from here, targeting 95 cents.
Eric Nelson, there we go, SD to EC, looking for 95. To the both of you, thank you. As we leave the ECB news conference behind, euro dollar, just a bit of a bounce again after rolling over, euro dollar 102. Eric Nelson there looking for 95. And if you're looking at spreads out of Italy and Germany, Italy over Germany, we're higher by about 21 basis points on an Italian 10-year, on a German 10-year. We're pretty much dead flat at 125. From New York City, this was the countdown to the Open for our audience worldwide. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, July 21st. Here are the top market stories that we're following for you at this hour. Finally, at zero, the ECB makes an historic move, ends the era of negative rates, scraps forward guidance, unveils a new tool to fight higher yields. Now what? American Airlines flies to profitability. The airline delivers its first profit since the pandemic while risks circle from fuel prices to staffing. We're going to speak to CFO Derek Kerr. And cracks show in the U.S. economy. Weekly jobless claims rise. Big tech goes on hiring freeze. Ford announces layoffs. Philly Fed index sinks. How to trade all of this data. From New York, I'm Alex Steele with Tom McKenzie in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Tom, Guy's going to be really sad that he missed today. This historic move by the ECB. My question is, if you look at spreads right now, did they do enough?
It is one for the history books, isn't it? So you get that 50 basis point move. It was split in terms of the markets as to how hard they would go. Front loading has been part of the commentary. But then, of course, Alex, as you know, the details around that anti-fragmentation tool, Madame Lagarde saying, I don't want to use it, but we will, and we will be determined to use it if the case and if they meet that criteria. And the question marks around Italy, you're seeing the yields still elevated, of course, sell-off across 2s and 10s, currently at 361. That is a move high of 22, but the spread hasn't really blown out much further than it had at the earlier stage of this morning.
It is really hard to see that Italy fits the bill to get access to the TPI, but who am I to say? We're going to get to that in just a second. I do want to point out some breaking news for you here. U.S. mortgage rates now climbing to 5.54% as housing demand softens, yet we have moved so far, so fast. And Tom, this is the moment when Guy would remind me about how good my 30-year fix is, which is 2.85%. And that is a huge difference from where we are now. And that was just about a year and a half ago. And that's like hundreds of dollars more on monthly payments. It just shows how unaffordable housing here in the U.S. has really become.
Yeah, we had a Bloomberg story yesterday about Americans looking to Europe to purchase houses precisely because of those costs that you guys face. But yeah, you're locked in that 30 years. I'm looking to refinance next year. I'm going to be faced with much higher rates. But there you go. 5.54% is what you're looking at in terms of mortgage rates stateside as it ties into the housing market. Now, the ECB, of course, raising its key interest rate by 50 basis points. It is the first increase in 11 years and the biggest since 2000. Madame Lagarde of the ECB, of course, the president, addressed the move.
We decided to raise the three key ECB interest rates by 50 basis points and approved the transmission protection instrument.
Okay, let's get the latest now from Bloomberg's Danny Berger, who is on the ground in Frankfurt. Danny, you are living history. What were the key takeaways for you?
Well, I mean, history for the ECB and a huge shift for the ECB. It is clear that they are different post this decision. For one, I think it's really important to emphasize what Christine Lagarde said in that conference. She said, quote, they made this decision and they will make further ones being data-dependent basis, will operate on a month-by-month and step-by-step basis. Forward guidance, it is out the window. So that means when they set expectations of September that it would be bigger than 25 basis points, sure, that might still be the case. But again, it will depend on the data. Now, the final point of where we end up, that is the same. So it is clear that they are front-loading at this point. And of course, the other remarkable thing about this is it was unanimous. It was unanimous on the 50 basis points. It was unanimous on the TPI. Christine Lagarde also laying out 4 clear criteria for meeting that framework of the tool, also set out in a press release as well. But she really batted away every question about Italy, about whether she was concerned, whether they could apply for this, whether it was applicable to them, going so far as to not even say Italy, just saying the country in which you referred to.
Right. It really raised a lot of question marks on that. I also found it fascinating that you talked about the private sector securities, that could be considered. Yeah, I thought that was pretty interesting. Also, the fact that the euro exchange rate factored in to their decision to hike 50 basis points. What did we learn about that?
Well, you got to wonder the fact that she said it not once but twice, the fact that the euro was leading to higher inflation among other factors. It would not be surprising if we get closer to parity to see more verbal intervention. It is clear that this is something that concerns them. Maybe it's even something that pushed the hawks pushing the doves to 50 basis points. So it's clearly in their thinking, but it is also clear that they are leaving themselves a lot of discretion, whether it be, to your point, investing in private assets, or again, deciding in who gets access to TPI.
All right, digesting all of that. Danny, thank you very much. Great to see you. Bloomberg's Danny Berger joining us there. Let's get to more market reaction, what it all means. We're joined now by Marcus Ashworth of Bloomberg Opinion, and Kit Jukes, a SocGen Chief FX Strategist, joins us as well. Marcus, the day is finally here. We got out of negative rates. Did they do enough?
Well, it's the devil's in the detail, and basically they did enough on rates, though I note they didn't really forward forecast. I know they dropped their guidance, and yes, they have mentioned the currency, but the fact there isn't a commitment to go another 50 in September is a little disappointing. But that aside, it's the fact that this is an obvious compromise, that the reason they've got this anti-fragmentation TPI, what do you want to call it, tool, in existence in any shape, form or size is because they've gone this 50 basis points. It's an uneasy consensus, and people feel that perhaps the chance of this TPI ever actually being used is not going to be because it doesn't need to be used, it's because it won't be allowed to be used. And there will be such strict conditionality, particularly on the sustainability of Italian debt. You know, we had a comment this month from the Bundesbank chief saying that he didn't think how people can assess this on the spread, and he poured cold water on all of it. That hasn't gone away. He may put his foot down and stop the TPI ever being used. Therefore, it may therefore be useless. Hence, the market reaction is very, very sceptical.
A sceptical market reaction. Kit Jukes of SocGen, let's bring you in at this point. To Alex's point, really underscoring that comment, the two times that Madame Lagarde addressed the currency, euro dollar, was it parity, do you think, that led them to factor this in? They also always will stress that they don't target the currency, but how does this change your thinking about the euro and the next level for the single currency?
I think it's confirmation of the fact that at a time when you're number one of your big problems, ECB's got plenty, but one of your big problems is inflation, a weaker currency really isn't helping, and so it's recognition of that. Whether it was parity, whether it was the speed of the move down in the last leg from 107 down towards parity, at the same time as we saw spikes higher in yields from the big push up in the States, you know, it's that sort of combination where they're looking at it saying, okay, the inflation problem is bigger than we thought it was. The move upwards thanks to inflation and yields is bigger than we're comfortable with. We need to do stuff, and so they are leaning against the currency, at least in that regard. The question, of course, is whether that makes a blind bit of difference when the elephant in the room, vulnerability to a further reduction in gas supplies, is still in the room.
Right, which in essence has what the euro has been moving on, was the gas supply story. So, Kate, do I make a line here? If we get to parity and we stay around parity, they're going to keep hiking? Like, can I look at that for September and start betting on that?
I think if the euro is still down here, I think, look, yes, up to a point, except that there's a reality. If the European economy is still growing significantly in September, they'll probably go 50 if that is where they go, because the inflation problem's not going away. The challenge for them is that the danger is that the economic hit gets big as soon as we start having to cut back on electricity consumption across Europe, and that'll be where the problem comes. It gets big if the U.S. economy rolls over soon as well. So the growth hit comes separately from all of that, and that's what will stop them. But they will be more concerned by inflation if the euro immediately now drifts back down through parity between now and the end of the summer.
Marcus, on the question of Italian debt then, BTP is currently at 358, up 19 basis points at the 10-year, up 25 basis on the 2-year. Do we look ahead then to what happens in terms of the elections in Italy, the formation potentially of a populist government, and how they respond to the reform agenda, and how that ties into the question marks around debt and, again, the utility of this tool?
Well, I think it's interesting you mentioned the 2-year, because that's something I think people are not getting enough attention to. It's all about the sustainability of Italian debt. And it's risen so sharply, the curve is so steep, that the 2- and 3-year yields have risen substantially over the last month, where in fact long-term yields are actually lower. So it's really, where does Italy fund? And in the next 4 or 5 years, it's got about 800 billion euros to fund. Now, normally you want to be able to fund cheaply, so it's the shorter end. But if you're paying, in excess or around the 3%, Is that sustainable for Italy? Clearly, when 10-year yields got above 4%, that's when the ECB panicked and had that emergency meeting. But really, it's the shorter end of the curve, the 2s to 7. The average maturity of debt overall for Italy is around 7 to 8 years. They've got to be able to fund cheaply. I think if it's above 2.5%, as it already is, it's a very big question mark whether Italy is actually sustainable in the long run. Short term, it can still fund, but the long run, is this sustainable?
So, Marcus, quickly, how much do you think the market then pushes around Italy to push around the ECB?
A lot, and that's my real worry over the summer. It's not going to be an easy one. It's no time for the sun loungers. They think they've done as much as they can. Unfortunately, this looks like another classic ECB correction after correction, perhaps later on today or maybe tomorrow, where they stiffen up the language. And Lagarde's comment that they don't really want to use this, that's something she's going to have to rephrase, I suspect, because the conditionalities, the fourth conditionalities is just too wishy-washy. We need a clear bazooka, loud and bangy.
Put away the sun loungers. Put away the sun loungers. Pull out the bazooka. Loud and bangy.
That needs to be the lower, right there.
Yeah, let's put that on lower right now, please. Loud and bangy is what we need. Kitchux, just very briefly, do you align with that view from Marcus? Are the market's going to bully the ECB in the months ahead?
Look, I think the summer's difficult. Every summer's difficult. The markets are going to be thin and people will be nervous about it. In reality, the original spike up in BTP yields came because Bund yields spiked up, came because U.S. Treasury yields spiked up. At the end of the day, the biggest single driver of the problem, to my mind, is that the ECB reacted so much in so much alarm at a natural decompression of spreads in what was that really violent move higher in U.S. yields. So what happens is the big issue is what happens if we get another spike higher in US CPI just because the base effects aren't so friendly, and we get that over the course of the summer. That'll just encourage thin markets and difficult times, and yeah, I think that's a significant risk. And in that process, for what it's worth, I'd see more than 50% chance that Eurodollar will be back under parity by the time we get to that next meeting in September, and if thin markets can just make this worse.
Okay, more than 50% chance that you get back to parity by that meeting in September. Always excellent. Kitchux of SocGen, of course, and Marcus Ashworth of Bloomberg Opinion. Thank you both. We're going to have more on the ECB decision with Peter Prate, former ECB chief economist, in the next hour. And coming up, big tech in focus this week, and next we're going to ask our next guest whether we have indeed reached a bottom in tech stocks. Amy Wu Silverman of RBC Capital joins us for analysis as we look ahead to the earnings of next week. This is Bloomberg.
earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, well, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projection, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We are a company that has been growing quickly. This year, our headcount will grow by more than 20%. Obviously, now we're mindful of the environment. So as we look forward, we'll continue to grow, but I would expect that pace will probably moderate.
That was Blackstone President John Gray. We're going to have more of that conversation later on in the hour. Let's turn to the question of the day. You're taking a look at markets here. S&P up by 0.5%. The NASDAQ 100 turning negative by 0.2%. But has tech really bottomed? You look at the NDX. We broke through the 50-day moving average earlier this week. We've been on a pretty steady climb, particularly as tech earnings are front and center next week. So let's dig into that question with Amy Wu Silverman, equity derivatives strategist at RBC Capital Markets. Amy, are markets positioning for this bottom in tech and for potential rally here at this point?
Yeah, it's interesting, Alex, because, we've been watching this very closely. We're going into an extremely tech-heavy reporting week next week, obviously big impact to the Qs and XLK. Overall sentiment, both on the Qs as well as on your big large cap stocks like Amazon or Microsoft or Meta, skew is really low, so that indicates very bullish option sentiment. I would say really the only fly in the ointment is Apple, where it's noticeably the other way around, very bearish sentiment in options heading into earnings.
Amy, what is the Apple story then? Why is that the outlier?
Yeah, it's interesting because, a lot of times, especially in derivatives land, we kind of need to wait until right before earnings to get really a good sense of positioning. But noticeably in Apple, through all tenors, so 1 month, 3 month, 6 month, and 12 month, your demand for downside protection is actually close to 1-year highs. I mean, there's possible reasons. One, simply just that it's recently been outperforming. But that demand for downside protection is there, and we've been discussing the July 29th, 145, 150 put spreads as a way to take advantage of that skew and place on a hedge if you do believe there's concern ahead of earnings season.
So, Amy, I'm wondering if we pair that with overall positioning and with downgrades that we're starting to see also. Apple's got a couple downgrades over the last few days on FX and also slowing demand. Are we setting ourselves up for rallies into numbers like we saw with Netflix? Things aren't as bad as we thought, therefore we rally, and do we need to start hedging for that?
Yeah, it's a really interesting nuance, Alex. And so one thing I'll say is when we headed into this earnings season, I really thought we were going to follow the playbook of the last 2 quarters, which is you had all these companies where they were kind of implying these regular moves and they've got huge implied move beats. So Netflix is a good example. It was down 35% on earnings last quarter. It was implying an 11% move. We're pretty much seeing the opposite. Now, things are early, right? We're really not into the belly of earnings season yet, but I do agree with you that, a tail risk, more of an upside tail risk, is that we essentially get the opposite of the playbook we've been expecting from the last 2 earnings quarters.
Amy, how much of this is about a readjustment to rates as well, at least a diminished sensitivity within the tech sector to rates that are 296 now on the US 10-year?
Yeah, I think that is a big contributor. I think sentiment has a lot to do with it. And I also think, we've seen the data that just tells you where sentiment and flows have been. So it's possible, have we reached capitulation? A lot of the metrics do point to that. I think, again, you can always be surprised by extrinsic factors when you head into earnings. Mm-hmm. But, that is part of the narrative of why equity volatility has underperformed a lot. Now, I've always thought that, the rates volatility will trigger an up move in equity volatility, but I do think that is a risk to that view, is essentially what happens with the positioning.
Amy, let's just hit on FX for a second. I just want to get a sense of dollar positioning because a lot of the multinationals are lowering their estimates for the year because of a strong dollar. We also heard the ECB talking about basically the euro weakness leading them to hike more. What is the easiest way to play the dollar right now?
Yeah, so you know, if you look to options, there are a couple different proxies. One would be UUP, which is essentially dollar against the basket, so you know, strong dollar view. Another would be, and we're seeing this trade in the market, is FEZ, so a Europe proxy, looking at hedges there. So that, you know, these are ways to kind of essentially play not only a kickstart to volatility view, but also to a view of overall, you know, outperformance of one versus the other. The other thing I'll say is clients are asking us about individual companies where, you know, maybe their revenues are in euros, but their debt is US dollar denominated, and you know, really idiosyncratic concerns on the options level, how they can hedge those.
Interesting.
Amy, from one side of the spectrum to the other, in the energy trade, the commodities trade, has that now crumbled in light of the pricing pressures that we've seen and the likes of iron ore and copper and to some extent oil as well, back below $100 on WTI? That was a favourite coming into the beginning of this year, was the energy trade. Is that starting to come off now?
You know, what I think is fascinating there is obviously, you know, when you stack all those year-to-date outperformers, it's clear and far and away is energy, even with how it's come down. But what has interested me is that the placement of hedges hasn't moved all that much. So what I mean by that is we continue to still see people, you know, use energy upside through the options market. So for instance, a call spread on XOP or a call spread on XLE as an energy company proxy placed out to September and October. And, you know, that's very likely, you know, potentially what Putin could do as the winter months are coming. You know, these tactical plays are still being put into the market despite kind of the recent trading events we're seeing.
Amy, this is a throwaway question, but let me give it to you. What is your favorite trade right now? What's the cheapest and the best trade that you're noticing that no one's taking advantage of?
Yeah, you know, look, this is very contingent on if we can see a kickstart to volatility, which I still think we can. I think you look at VIX calls and call spreads. I think that Apple trade I mentioned, given that pickup in skew, that 145, 150 is interesting as well.
Okay, Amy Wu Silverman of RBC Capital Markets, thank you very much. As ever, of course, for breaking down your views on tech and the broader markets as well. Just a redhead crossing the terminal, the US President, Joe Biden, has tested positive for COVID-19. That line coming from the White House. Alex, presumably he's had at least 3 shots at this stage. What's your take on this?
I'm thinking that someone's getting some Paxlovid. I feel like if this headline had crossed a year and a half ago, it would have been a different kind of scenario, considering that he is in the older population and such. But with the Paxlovid now and other options, it feels like they could be much more contained. We are looking at the S&P down by about 0.5%. Again, that breaking news, according to the White House, the U.S. President Biden has now tested positive for COVID-19. This is Bloomberg.
This is Bloomberg.
Let's get back to that breaking news. President Biden testing positive for COVID-19. He is currently on Paxlovid. Anne-Marie Hordern joins us from D.C. Anne-Marie, what do we know so far?
Well, we really only know what we hear from the press secretary, and that is that the president has tested earlier this morning for COVID-19. Remember, he is just back from a very long foreign trip. He was in Israel shaking a lot of hands. He was also in the Kingdom of Saudi Arabia. He was supposed to be in Pennsylvania today, but he will be isolating and following CDC guidelines per this statement from the press secretary. We'll continue meetings, of course, over Zoom. If we could bring you a little bit more of what the press secretary is saying. He is fully vaccinated. We know that. Twice boosted. We know that. We all witnessed that on TV. The press secretary says he's experiencing mild symptoms and he's begun taking Paxlovid. This is consistent with CDC guidelines. He'll be isolating. He has been in contact with members of the White House staff by phone this morning and will participate in planned meetings at the White House via Zoom. So obviously this is something we're going to keep an eye on because he is the man who holds the office of the United States, the presidency of the United States. But for many, obviously, this is potentially was always going to be a risk, of course, right? You do see people still contracting COVID even though they are vaccinated.
Anne-Marie, thanks a lot. We really appreciate it. We'll be sure to follow any headlines as they cross. Again, President Biden testing positive for COVID-19, experiencing mild symptoms according to the White House, and has started treatment of Paxlovid. The S&P off, though, by 0.7%, the lows of the session. This is Bloomberg. We're an hour into the U.S. trading session here. The S&P off by about 0.6%, around the lows of the session. Kriti Gupta is tracking all those moves for us. Kriti?
Yeah, Alex, a little bit of a reversal of what we've seen in the last couple of days, where you did have that weaker dollar, stronger stock market story. Today, you are not seeing that. You are seeing a little bit of a reversal. What's interesting, though, is that outperformance theme that you have seen in the last couple of days, where the NASDAQ outperforms to some extent the S&P 500. That is still in play, and you can see it's down 0.6% on the NASDAQ, but not as much as the S&P 500. So we're going to keep an eye on those tech earnings in particular, the tech movement in particular, as you have the likes of, for example, Apple, Google, Microsoft, talking about slowing down some of that hiring. Right now, the stock market taking that still as a little bit of a defensive tilt. But the airlines I really want to keep an eye on here. Down a whopping 5% for the airlines index. This comes after American Airlines and some of its rivals actually talk about their flight capacity. They're going to drop it by, get this, 10%, as if the airline chaos wasn't bad enough. Now they're going to try to deal with those travel costs by cutting down on that front. Let's talk about the macro story, though, because this absolutely does play into that stronger dollar story that you're seeing. It has everything to do with the ECB. Now, of course, we did just hear from the ECB a record rate hike, 50 basis points, the first rate hike going all the way back to 2011. And on the surface, that was good news. That's really where you saw this massive spike here in the euro, perhaps helping those interest rate differentials, and then a complete turnaround as you started to see President Lagarde actually speaking about the TPM tool and simply just how it's going to work and the guidance for the next couple of meetings. Short answer is we didn't really get much of it, and that's really where you're seeing some of that reversal completely turn around. Let's also talk about some of the other stocks that are moving here because, or actually let's go stick with the macro. Let's talk about oil first, and then we'll talk about some of the other stocks because this is still significant. Oil is down, gasoline demand staying about stable. We're going to keep an eye on that because very quickly oil can turn into this inflation hedge, to a recessionary call, to a growth signal, and right now it has a lot to do with those underlying products that we're going to keep an eye on. Of course, like I said, gasoline demand, we're still at about 2020 levels. That is not necessarily a good sign when it comes to an economic recovery. Now, as promised, let's talk about those big movers. Tesla is coming out with those deliveries. The biggest issue here for Tesla was their relationship with Bitcoin, I would say. The idea here that even though they did come out strong on those deliveries and they talked about a little bit about the supply chain issues that they're somewhat kind of working around, their Bitcoin conversions were very key into turning into that fiat currency. So really watch that relationship of that stock with cryptocurrencies broadly. CSX, that railroad, coming in with some pretty strong earnings. Remember, they have a lot to do with chemical movement as well. They came out on top. So transportation is a key theme. Like I mentioned, United Airlines really taking it on the chin here, down 9%, Tom. And of course, a lot of that, once again, has to come with that flight capacity getting cut.
Kriti Gupta, thank you very much indeed. Well, let's stay with the airline sector then. Of course, Kriti doing a fantastic job of breaking down some of the pressures across that space. Airline executives took the opportunity to connect face-to-face earlier this week at the Farnborough International Air Show. One big focus, of course, supply chain constraints.
We had the MAX grounding, then we had the pandemic. Air traffic dropped 90%. But we also saw a huge drop in production. And then when the pandemic hit, overall production rates went down 60% across all the programs. And so we saw a huge reduction in revenue, in cash flow. We had to lay off workers. And so it was a challenging 20 and 21.
At Airbus, we have a very large backlog, and the priority is to serve our clients, to serve the existing clients. So we will be taking orders as well, but we're really focusing as much as we can on getting things in order in the supply chain and being able to deliver.
We're seeing where the weak points are in the supply chain now. 6 months ago, it was hard to see some of those weak points. A lot of us made assumptions about bringing back resources based on past practice.
Okay, American Airlines was out with results earlier today. In terms of per share profit, that matched expectations. Revenue was a beat. CFO Derek Kerr joins us now. Derek, those were some of the top lines. The other line that really caught people's attention was, of course, the 10% capacity cut for this quarter. When do you expect that all of these issues around supply chains, of course, the shortage of labor, do you have any clarity, any transparency at this point as to when those start to be ironed out and when you can get that capacity back online?
Yeah, well, first of all, Tom, thanks for having me here. I really appreciate being on the air today. I just wanted to say, congratulations to our team. It's been an incredible time the last 2.5 years, and to be able to get the company back to profitability, which was one of our major goals as we went into this year, to get the company back to profitability is really a great feat for us. So that's number one. Yes, we did pull capacity in the third and fourth quarter. We are seeing some, the demand is still strong. Demand is really off the charts, so the demand is still strong.
But, you know, we have some operational issues and things that we need to resolve. So what we've done is pulled the capacity down to give some relief to our team. You know, we pulled down about 2.5% in the third quarter and about 3% in the fourth quarter, so down about 1.5 points for the remainder of the year. That's to give us some relief to match the resources with the operational difficulties that are out there today. And, you know, we don't know when we'll be out of it. So what we need to do is make sure that we have capacity that matches what the resources we have and what the operation issues that are out there to make sure that we fly what we need to fly for our customers.
Hey, Derek, Delta said today they're going to hire and train more than 2,400 pilots this year. That seems to be one of the biggest constraints when it comes to capacity. Do you guys have any clarity on what you have to do on the pilot level?
Yeah, there's two sides of it for us, because you have the regional fleet and you have the mainline fleet. We're hiring over 2,000 mainline pilots also, and we're ahead of schedule for that. So that's all about, on the mainline side, it's all about getting people through training and make sure that we get people all the way through training. That'll take a little while as we build up the training. Last year we had about 1,000 pilots that we hired. This year 2,000 pilots. So you have to have the infrastructure to be able to do that. We're growing into that. We're going to be through that by the end of the year and hopefully beginning of next year to make sure that the mainline flying is back where it needs to be. On the regional side, it's going to take a lot of time. You know, we have a big regional fleet, about 600 aircraft. We had about 100 aircraft down in the second quarter. That is where the pilot supply issue is going to be hit. We are working that. You know, we've given increases to our regional fleet, our wholly owned regional pilots, to make sure that we can bring on pilots, and that's a lot of focus that the entire industry has, is to make sure that that regional feed has pilots. The main line is it's not an issue. It's the training. It's making sure we get everybody through training, and we're all working on that.
And Derek, you talked about that continuing robust demand, and we've seen that resilience, haven't we, from the consumer, just desperate to fly and travel again on the back of that pandemic. Are you seeing any evidence at all that that's starting to be eroded, given the higher costs, given inflation, given concerns about slowing growth in the U.S.?
Not at all. You know, we just guided to the third quarter of our total revenue per ASM being up 20 to 24%. It was up 22.7% in the third quarter. So we don't have a huge window to go out. You know, we have a 90-day window that we look at, and we have, you know, bookings out into the holidays. There's no sign whatsoever from that perspective that, you know, bookings are declining or demand is not there. So demand is strong. It's continued to be strong. We plan it to be strong as we go into next year. We just want to get the utilization of the fleet back up to make sure that we can, you know, match demand with the supply.
I can see the visibility for next year is going to be tough all around. And I'm wondering if we're going to be in a situation with the airline sector where all of a sudden you hire all these people, you train all these people, you're hiring over 2,000 pilots, then you ramp up capacity, and then all of a sudden the demand just isn't there, either because we're in a recession or because people don't want to travel by plane anymore. Business travel may now come back, and then it becomes a cyclical story again. What's your level of confidence that that won't happen?
As we look at it right now, demand is so far outstripping supply that we would like to have more aircraft up in the air. I think the entire industry would like to have more aircraft up in the air. But we need to make sure that we do it prudently. We need to make sure that, you know, we match the resources we have with the supply as we put it out, and obviously the operational challenges that we have throughout the industry. So we need to match that. I think as those things subside, we can put the capacity back in to meet the demand. Now, if demand comes down, we will always adjust to that. And in today's world, we're flying less than we want to fly. But as we look forward, we have a lot of aircraft coming for delivery. We have a lot of aircraft that are on leases that can be returned. So we have a lot of ways to pull the capacity down if the demand is not there. We're not seeing that today, which is really good news, and we wish we could fly more, but it is really prudent for all of us to pull down the capacity to meet the resources that we have and make sure that we're, you know, providing the customers what they need from an operational perspective.
Derek, just briefly, how do you see the difference, the demand in terms of the travel demand versus the business demand evolving, and the impacts on airfares going forward?
Yeah, leisure demand is fully back, as everybody knows. The business demand is probably back. For us, we're over 100%, but we look at it a little bit differently. Small and medium-sized consumer or customers are back. Those businesses are flying. They need to fly to keep their companies going. Corporate demand is back at about 75%, so there's still a lot of room on the corporate side for that to come back. And even on the international flying, that's not fully back yet. It is growing. The second quarter, we saw some growth in that as we went forward, as things open up and as we see testing requirements change.
Yeah.
So there's a lot of growth still left in the corporate, and there's still a lot of growth left in the international that we see as we go into 2023.
Derek, I have one quick question. Fuel costs are crazy high right now. Would you be hedging? Would you start hedging fuel costs?
We have not hedged since 2006. It is back in that time frame. People had hedges in place, and really hedging is insurance. It's how much do you want to pay for the insurance and what does the insurance cost. At that point in time, you saw that effort. People had hedges in place. It dropped all the way down to $20 a barrel and almost put a lot of companies into bankruptcy. There is a natural hedge in our industry with fuel and revenues, and that's the way we're going to stay as we move forward. We're not going to go into hedging. In today's world, it would be very expensive, and the insurance isn't worth it. So what we do, and I think all of the airlines, you can see the hedging has gone down. There's only a couple airlines that do that today in the world. It would drive prices up, and it just doesn't cover what you want to cover from a fuel perspective, and that's driven.
All right.
We'll use revenues as the hedge for fuel.
All right, Derek, thanks a lot. Appreciate it. Derek Kerr, American Airlines CFO. Thank you very much. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. President Biden has tested positive for COVID, and the White House says he's experiencing mild symptoms. The spokeswoman says the president has begun taking Pfizer's Paxlovid treatment. He will isolate at the White House while continuing his duties. First Lady Jill Biden is testing negative, according to her spokesperson. In Italy, Prime Minister Mario Draghi has offered to resign. It's a move that will raise the prospects of snap elections as early as October. The collapse of Draghi's coalition government was inevitable after 3 of his partners withdrew their support. Italian governments are notoriously unstable. Draghi's was the 67th the country has had in just over 75 years. And Russia has resumed sending gas through its biggest pipeline to Europe after a 10-day maintenance period. EU officials were worried that the pipeline would stay out of service longer in retaliation for EU's opposition to the Russian invasion of Ukraine. Russia's been curbing gas shipments to Europe for months now, but the continent still relies on that little gas that it is getting. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg, Alex.
All right, thanks so much, Ritika. So Tesla posting some strong results, beating profit estimates, results reflecting progress in getting production back, while those supply chain issues and COVID lockdowns in its factory in China are still there. Here's what CEO Elon Musk said during the analyst call.
Q2 was a unique quarter for Tesla due to a prolonged shutdown of our Shanghai factory. The past few years have been quite a few force majeures, and it's been kind of supply chain hell for several years.
All right, joining us now, Garrett Nelson, senior equity analyst at CFRA Research, has a strong buy rating for Tesla and raises price target by $25 to $11.25 per share. Garrett, just in the short term, how long do you think the demand is going to continue this strong if we are headed into a recession as rates rise and the consumer purse kind of tightens?
Yeah, it's a good question. And the issue for Tesla really isn't demand, it's production. And the big positive there is that they have these 2 brand new factories, one in Texas and the other in Germany, which recently started up. They're in the process of ramping up to full capacity. And so that's going to really strengthen their sales in the second half of this year. And, you know, while the second quarter was you know, they had their fair share of operational issues in the second quarter, they ended the quarter on a strong note. Their production in June was the strongest in company history. They had a lot of momentum heading into July, and we think that momentum continues in the second half of this year and is going to lead to record-breaking earnings in the coming quarters.
Gary, what is your estimation then of how much they can ramp up production and capacity at both Berlin and Austin, and what kind of time frame?
Yeah, so at each factory they say they have a production capacity north of 250,000 vehicles per year right now. So, you know, in our view, they've done a really good job so far, you know, since their initial production at those 2 factories. But, you know, I think if you're a portfolio manager and you're looking across the consumer discretionary sector, which Tesla's in, and all you're seeing is consumers being crushed by inflation and pulling back on their consumer discretionary